due course. So the number is roughly 50 now. I think we can start.
Yes, I think, Brother Majd, it is better that we start because the time for all the participants is very precious. Yeah. We need to respect that. Yes, so although we had more registration, so we were waiting, but I think it's good enough. We should start.
Inshallah, in the meantime, others will be joining. So let's start. I'll start my intro, and then inshallah we can have a larger number going forward. بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Ladies and gentlemen, distinguished participants, guests, and dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It gives us tremendous pleasure to welcome you to today's public hearing session on a newly issued exposure draft of AYUFI Financial Accounting Standard, namely the off-balance sheet assets under management. This event is held in collaboration with Bahrain Banks Association, BAB, being amongst our key supporters and partners in the Kingdom of Bahrain. We would like to express our sincere thanks and appreciation to them for all the efforts and coordination put up towards a successful convention of earlier public hearings and hopefully today's session, inshallah. The public hearings are one of the key steps or stages in standards development, the due process, the so-called due process, carried out and undertaken by AYUFI, and it constitutes, as a stage, an opportunity for us to interact with you and benefit from the knowledge, experience, and wisdom of all professional individuals and experts from the Islamic finance industry and beyond on the new exposure drafts. As exposure drafts may have far-reaching effects, the input received at such interaction events would be more critical for us to ensure that the final standards do properly address industry expectations, but for sure without any compromise on Sharia precepts. Today's exposure draft represent one of the key outputs of the revision project conducted under supervision of AYUFI Accounting Board on Financial Accounting Standard 27, investment accounts, aiming to enhance the financial reporting requirements with regard to off-balance sheet assets under management, that is, assets managed in a fiduciary capacity without establishing control, and other relevant areas that have been already tackled under other exposure drafts. This AYUFI Financial Accounting Standard, in a glance, it sets out the criteria for characterization of off-balance sheet assets under management and all related principles of financial reporting in line with AYUFI's conceptual framework, the new framework, and as well as the presentation and disclosure requirements in line with the requirements of Financial Accounting Standard 1, FAS 1, particularly with regards to the statement of changes in off-balance sheet assets under management. And now, without undue delay, and for the interest of time, let me invite to the virtual floor Mr. Omar Mustafa Ansari, AYUFI Secretary General, who will present the exposure draft and walk you through its main content and structure while answering your questions in an interactive session. Brother Omar, over to you.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome and good morning or good afternoon, depending on the places of the world from where you are joining. A special welcome to Sister Amal, who is the chairperson for the working group, and thanks to her for devoting time for these public hearings. In addition to all the work,
welcome.
In addition to all the work you are doing, Allah bless you for your great work and commitment. With regard to this standard, as Brother Majd has mentioned, it's part of a larger project, and it is actually a revision of part of FAS 27. FAS 27 is already in place. FAS 31 on Wakalat Istismar is also in place. So this standard might not be bringing some very new requirements. Yes, these might be new requirements for some of the market participants who have not been following AOFI's earlier standards on Wakalat Istismar and FAS 27. For them, it might be having some new requirements, but those institutions who are already following AOFI's existing standards on FAS 27, FAS 31, not everything is new. Not only this, actually, as a part of this project, we have aligned the standard with the requirements of the new conceptual framework and the new financial accounting standard number 1, FAS 1, for general presentation in the financial statements. So the concepts are already there in AOFI's different standards. It is just an improvement in the earlier standard and sort of alignment with the requirements that have changed already. And obviously earlier it was a one large standard on all type of investment accounts together. But since there are a lot of new improvements in the market with regard to the product development, introduction of new products, etc., so we have got more sort of products and things that are to be covered under the ambit of the off-balance sheet assets under management. Even the terminology of off-balance sheet assets under management is the new terminology that has been brought under new framework and for new FAS 1. Earlier, the terminology was in the old standards, in the standard number 5 and 6 of AOFI, FAS 5 and 6, it was more like restricted investment account only. And then in FAS 27, which replaced FAS 5 and 6, the terminology was off-balance sheet investment accounts. But now we are talking about off-balance sheet assets under management, which is a broader term, includes obviously the restricted investment accounts, includes other off-balance sheet assets under management as well. And it obviously, as I mentioned, it aligns with the requirements of the new framework and the new financial accounting standard 1, and it builds upon whatever the requirements were there as contained in FAS 27 to sort of clarify some of the specific requirements and specific issues. One more thing that we have recently done is we issued a technical release on illustrative financial statements for Islamic banks and similar financial institutions, and that also includes illustrative statement of changes in off-balance sheet assets under management, which is the new name for the statement, which was earlier called the statement of restricted investment accounts or the statement of off-balance sheet investment accounts. There were some overlappings, redundancies, and anomalies with regard to different AOFI standards like old FAS 1, the old FAS 27, and some of the new requirements in some of the AOFI's newer standards. So this standard also avoids all of such redundancies and anomalies by streamlining whatever requirements were there. So I think this is enough of the introduction. It is today, I believe it's not going to take that much time because the standard is not as long and as detailed as compared to certain other standards. Secondly, the standard has a very important conceptual part, which is now taken to the standard on control of assets and businesses, on which we have already conducted, I believe, 2 or 3 public hearings, which is also part of this project. So the conceptual discussions with regard to what remains on balance sheet and what remains off balance sheet is also not contained in this standard. For the benefit of the attendees today, I will just summarize what is control and how the control is applied to determine what remains on balance sheet and what remains off balance sheet. The control definition as per IFRS is primarily talking about the power to govern and the right to variable returns. And both of these things are to be interrelated, means that the power to govern should be able to generate variable returns to yourself. So it means that we are talking about two primary characteristics of an asset to be in control. And whatever is in control is on balance sheet. Whatever is not in control is off balance sheet or cannot be recognized on your balance sheet. So this is the main criteria. IFRS definition has been slightly improved by OFI. We covered it in earlier multiple standards as well. But in a nutshell, we added a Sharia compliance element to the control definition, that is substantially all risks and rewards incidental to ownership are a definition, are part of definition of control. So if you control an asset, if substantially all risks and rewards incidental to ownership of that asset are with you, this is the Sharia part of the definition, and it can be interpreted interpreted by applying two of the conditions. That is, first, you have the right to variable returns. When we say variable returns, I need to clarify the variable returns have to be positive and negative. So it is not only the situation where you say, oh, my return can be 4% or 6%. No, the variable return element, even under IFRS, we clarified it more, but IFRS also has it available in guidelines that when we say variable returns, it is about having the risk of a risk of having a loss as well. So if something is not loss taking or loss absorbing, it is not having the full variable control. The second part of it is the power to govern for the purpose of getting the variable returns. Power to govern for the purpose of getting the variable returns is a very important condition. We need to understand that in some situations, the power to govern is there, but it is not for your own self-benefit, which is not for the benefit of or for the purpose of having the variable returns from those assets or liabilities. I do not want to go in these details right now because those are subject to the other standard, as I mentioned, on control. But since it was very important to understand the concept before we are able to understand this standard. So in a nutshell, if I have control, which means I have variable returns coming from that asset, and the variable return, I have the power to govern. Power to govern means to use, to consume, to sell, to dispose of, to gift. For all these purposes, I need to have the full power over this asset for the purpose of my own variable return. So if I do it something in absolute fiduciary capacity, I will not be. It will not be considered to be a control, because I'm doing this thing for the benefit of others, not my own benefit. So let's move to the standard, and we will start taking comments. With your permission, I'll share the screen. Okay. Most of the people normally ask the question, can we have the presentation? Normally, this presentation is not shared because this is exactly the same as the PDF of the standard that has been shared with you. The link, I think some our colleagues have already provided in the chat box. If it is not provided, the team will provide it now, but I think it is already provided. So you can all have the access to this standard along with other standards which are in exposure draft stage as a part of this project. You can have access to them, and you can download them and provide your kind comments today as well as in future through through written comments, and you can provide today in through our discussions as well. Please use Q&A tab, not the chat window. Q&A tab, you need to please use it for providing any comments or asking any questions. If the time permits, which I believe may permit today because it's a shorter standard comparatively. So in that situation, we'll be allowing you time to time to open up your mic and put the questions by using your mic. So with that, I take you through the standard. One important point is that we said that this has to be read in line with the conceptual framework and the standard on quasi-equity and the control of asset and business, because all the three standards are interrelated. They have a lot of things which are common with each other. It might have been a part of a single standard as well, if possible, but considering the significance of each of the topics separately, particularly considering that control applies not only in these standards, but other standards as well. And it has already been included at some of the control-related definitions and explanations and interpretation that have been provided in multiple AOFI standards already. So it has been decided to keep it as a separate standard. So, but from the perspective of AOFI, these three are interrelated, and these are all of the AOFI standards are to be read with the Sharia standards which are relevant, as well as with the conceptual framework, and these in particular are to be read together with the other two. The basic introduction I have provided, so I will not be going for the preface and the introduction. If anybody has a comment, we can take those comments. I would suggest only one important, I'll just take you through one important aspect, that is about the significant changes. So first, I would say the criteria of characterization as off-balance sheet assets under management based on control is defined, and unlike the previous standard structures, other than those based on restricted mudarba, have also been included in the scope. So earlier off-balance sheet assets under management or off-balance sheet investment accounts were only the restricted mudarba, and even under FAS 27, all restricted mudarba or restricted investment accounts were not always to be considered as off balance sheet. Some of them had a criteria similar to, because there was a criteria with regard to determination of off-balance sheet and on-balance sheet, and that criteria was not primarily control, rather it was characteristics similar to urea. So if your characteristics of RIA accounts were similar to urea, you were supposed to apply urea accounting, not the RIA accounting, that's off-balance sheet. But now we have made it much more clear and more structured, and the definition is there and the interpretations are there. And in the control standard, actually, there is a very good table, if you see that actually provides guidance on as to how in different type of investment accounts it is to be interpreted, whether control is established through power and through variable returns. The new definitions are inserted, as well as some of the definitions are aligned with the conceptual framework and new phase 1, etc., and as well as the new standards that we are talking about, which are going to be finalized together. Selection criteria requirements are prescribed for selection and for application of accounting policies for the purpose of off-balance sheet assets under management. This is an important point, that at times the investment motive and the information needs of the investors of off-balance sheet investment accounts are not exactly the same with the normal policies, but generally applying, you should apply the normal overall accounting policies in line with the OFI phases, except for where there is a specific need or matching concept requires, or the mismatch risk is there. So in those situations, you need to apply different accounting policy, but a proper disclosure is needed whether you applied proper policies or not. We have put improved disclosures, including the presentation statement, as I referred to, which is introduced by FAS 1 and new FAS 1, and we have already issued issued the illustrative financial statements for that. Impairment and onerous commitment situations are the new challenges that we have identified, because FAS 30 on impairment actually excludes the off-balance sheet assets under management. So we have actually clarified how impairment and onerous commitment situations are to be addressed in case of off-balance sheet assets under management. I cannot see any question in the Q&A tab. I am not sure if somebody has raised their hands, but if anybody raises their hand, I would request my team to let me know time to time if anybody has raised their hand. But for now, I'll continue. Now, coming to the objective of the standard. The objective of the standard is to establish the principles of financial reporting related to off-balance sheet assets under management in line with the AOFI conceptual framework for financial reporting, the new one. Scope. The standard shall be applicable on all Islamic financial institutions, the institutions preparing financial statements in line with the requirements of AOFI FAS with regard to the assets managed in a fiduciary capacity without establishing control, except for participants takaful fund or participant investment fund of a takaful institution. It's why when we are saying that these are to be kept separate, it's not because they are not off balance sheet under asset under management in our definition. For us, a participants takaful fund and a participants investment fund, both of them, PTF and PIF for takaful, are off balance sheet assets management under management. But the point is that FAS 42 and 43, particularly 42, covers the disclosure requirements, etc., for them in quite detail. And those are specific to a type of business. So the specific overrides the general, and that's why 42 FAS 42 applies there instead of this standard. Secondly, an investment fund managed by the institution being a separate legal entity which is subject to financial reporting in line with the requirements of relevant AOFI phases. Second thing is that some of the banks actually have mutual funds and other type of investment funds, what we also call collective investment schemes. It can be a REIT, that is real estate investment trust. It can be a pension fund. It can be a mutual fund. It can be a Sharia compliant hedge fund, exchange traded fund. So there can be different type of funds that are there prevalent in different markets. The point is that if a fund is created in form of a separate legal entity, which means that it is given a separate legal status, either as an incorporated entity or through trust or through other mechanisms that are prevalent in different jurisdictions, then that one will apply FAS 14, which applies on investment funds. It will not apply this standard. So FAS 14 requires full financial reporting for the investment funds, and while AOFI is currently revising FAS 14, hopefully it will be revised soon. We are already in advanced stage for that. But the point is that a specific standard is available for any investment fund which is in form of a separate legal entity. So as an Islamic bank, if either directly or through an asset management company, I form specific funds which are taking form of a separate legal entity, that goes to FAS 14. If they are not in form of a formal legal entity, rather they are in form of virtual entities, in that situation, they are subject to requirements of this standard. Coming to the definition, now I can see two questions in the Q&A tab. The comment is Fathur Rahman Saleh. What is the practical obstacle that raised by the practitioners that lead to developing the standard? I mean, this is standard. Brother Fathur Rahman, I think the point is that mostly the requirements of this standard are already there in one or another of AOFI's standards. So it is not about practical obstacles, rather it is to align the requirements which are contained in different standards already. FAS 27 already contains the requirements regarding restricted investment accounts. FAS 31 already contains requirements with regard to Wakala bil Istismar, which is off balance sheet. FAS 1 already provides the requirement for having a statement of off-balance sheet asset under management. Framework already explains some of the requirements. So it is not the issue that there were so many practical obstacles that we were coming. Rather, it is more about aligning the requirements that are already contained in some of AOFI standards. And obviously, we are trying to improve the disclosure and presentation requirements for fairness and truthful representation. So this is not about practical obstacles, it is about this. Having said that, it's in some of the jurisdictions, we are aware that the off-balance sheet accounting is not preferred. There is a challenge with regard to IFRS. IFRS, in most, although the principal agent relationship and control related things and the asset definition and all these things which are there in IFRS, they can be interpreted exactly the way we are interpreting and applying them in this standard. But there may be argument with regard to some of the products under IFRS to be considered as a liability instead of being considered as off-balance sheet. So for me, if you ask me, the biggest obstacle is with regard to challenges that are posed by IFRS accounting. While we highly appreciate the quality of IFRS and we fully believe that IFRS are the top quality standards and can be basis of accounting in most of the manners, but there are some of the Sharia issues which are to be addressed primarily based on Sharia and the business model of Islamic financial institutions, rather than applying the IFRS as it is, considering them similar to conventional products. So one of the challenges and obstacles that is there for the regulators and for the industry is that some of the products that are considered to be off balance sheet by AOFI, considering the right interpretation and the right Sharia requirements, might be considered as on balance sheet and as a liability by some of the, like the issue of continuing involvement is there, the issue of true sale is there. So there are some of the challenges like if I create a Wakala bil Istismar account and I actually transfer some of the assets to that Wakala bil Istismar as underlying assets for that, if that Wakala is not commingled with Mudarba, then it becomes off balance sheet for me because it is a principal agent relationship. On the conceptual part, IFRS and our standard do not have any difference with regard to applying the conceptual part of principal agent relationship. Even under IFRS, the principal agent relationship, etc., they are to be considered the same way they are applying. But the point is that at times in IFRS, there are additional conditions that nullify the principal agent relationship, for example, continuing involvement, etc. So other than that, these are the practical obstacles which are faced by some of the regulators and the market practices where there are the IFRS is predominant accounting regulation. But other than that, what we are trying to do is actually reflecting what is already there in the AOFI's conceptual framework and other AOFI standards already. Coming to the definitions, fiduciary capacity is the capacity to act in good faith on behalf and for the benefit of another party with a duty to preserve trust. This is very important point, that if you are doing something purely in a fiduciary capacity, then in that situation, your acts are considered to be the acts of the principal, and in that situation, nothing comes on your balance sheet, rather everything remains on the balance sheet of the principal. Off-balance sheet assets under management are assets managed on behalf of the investors in a fiduciary capacity, but not under control of the institution, and include participatory investment instruments and off-balance sheet investment accounts. Off-balance sheet investment accounts are investment accounts that meet the definition of off-balance sheet assets under management in line with the conceptual framework, including those offered and managed by an institution that are not under control of the institution. And participatory investment instrument, this definition is in the quasi-equity standard as well, commonly referred to as an account, like participatory investment accounts, is an instrument held by an investor under profit or loss sharing or taking arrangement, for example, Mudarba, Musharaka, or Al-Wakala bil Istismar, representing funds received by an institution for investment on behalf of the investment account holder with or without conditions as regard to how the funds may be invested, whereby the holder of the instrument is entitled to the residual interest in the underlying assets. These definitions are very important to interpret and apply as to what remains on balance sheet and what remains off balance sheet. So the first thing is criteria for characterization of as off balance sheet assets under management. Participatory investment instruments may be divided in two main categories. First, whereby the institution controls the underlying assets, which are classified as quasi-equity instruments. Second, whereby the institution does not control the underlying assets and manages the same only in a fiduciary capacity, which are classified as off balance sheet assets, off-balance sheet investment instruments. In order to be characterized as off-balance sheet assets under management, a participatory investment instrument shall be subject to the conditions specified below. A, it manages participatory investment instruments and related liabilities and resulting income and expenses, including gains and losses, on behalf of investors only under a fiduciary capacity. The common structures used for these instruments are based on Al-Wakala bil Istismar, restricted Mudarba, and other Wakala arrangements. In case of participatory instrument, investment instrument, it is entitled only to a fixed or variable fee, including incentives. So incentive is part of variable fee, but it is not variable return, because variable return includes the risk of loss also. I just want to clarify here that the variable fee, variable returns, incentives, these are not indication of full variable returns, because full variable returns means risk of loss also. Share of profit or a combination thereof according to the Sharia principles and rules as remuneration against management of the underlying assets. However, the institution is not entitled to any residual interest in the underlying assets except to the extent of such established remuneration. See, it does not control participatory investment instruments in line with the definition of control, and hence it's not entitled to or exposed to the variable returns from its involvement with such underlying assets. D, a mudarba shall be considered a restricted mudarba if and only if the Rabbul Mal has reasonably restricted. Now, the term is reasonably restricted. So if I say that, okay, you are going to invest only in Bahrain, this is a restriction, but this is not a reasonable restriction, restriction, because the avenues within Bahrain might be quite big enough. So if a mudarba shall be considered a restricted mudarba if and only if the Rabbul Mal has reasonably restricted the independent and decision-making powers of the mudarib in respect of management of the mudarba investments. The conditions specified in paragraph 5 shall be tested against the following common criteria. Specifying an asset pool. Sister Farida, just make a note of it. We are talking about paragraph 5. This same para, or we are talking about the earlier para. Just make a note of it. Okay. Okay. Shall be tested against the following common criteria. In specifying an asset pool separately from the common assets of the institution without commingling with the institution's own funds or unrestricted mudarba investments. So this is one of the conditions for restricted mudarba to be considered as restricted investment accounts and considered off balance sheet. So if there is a common commingling, then it will not be considered, or a right of common commingling, then it will not be considered as off balance sheet. This is something that we have clarified in, as I mentioned, in a table in the control standard, where it clarifies that how the things change with regard to the decision making for classification of different type of instruments depending on different conditions. 2, defining an investment boundary, for example, through defining investment motive, market, platform, risk appetite, assets or asset classes, liquidity profiles, currency, geographical distribution, customer or customer classes. I'm sorry. And restricting the replacement, transfer, reinvestment rights of the mudarba investments, and the off-balance sheet assets under management managed by the institution on behalf of investors shall be considered as a separate virtual reporting entity for recording, monitoring, and reporting purposes. So see basis of conclusion 1 and 2 of FAS 40 with regard to the discussion on the virtual entity. Sister Farida, I think on the control and other standards, we also just need to create the same references as recommended by PMCC. Just make a note of it. Okay. Any comments? So what we are saying, a restricted investment account, which is based on a restricted mudarba contract, which significantly, reasonably restricts the rights of the mudarib for decision making with regard to investments, which does not keep his decision making powers as absolute with regard to these investments. So the powers to govern become not absolute, incomplete, and additionally they become more in a fiduciary capacity, and particularly if the commingling of the funds and commingling rights are not there. Because in URIA, normally you commingle your funds and other funds that are at your disposal also. But in restricted investment accounts, if you start commingling your own funds, then it becomes more similar to the URIA accounts, unrestricted investment accounts. So these are the criteria which are to be applied to consider an investment account to be a restricted investment account and to be considered off balance sheet. Now, just to clarify, based on FAS 27 and 31, which are already there, and based on the requirements of control, mudarba is to be divided into restricted and unrestricted. Mudarba, which is unrestricted, remains on balance sheet because there is control. And how control is established? There are different criteria for establishing control. So we believe the variable return for your own benefit is there, and the decision-making power is absolute. With regard to Mudarba, which is restricted, the decision-making power is not absolute, and because your funds are not commingled, then the risk of loss is nearly not there. Because in unrestricted Mudarba, the risk of loss is also there because the investors are coming and going and your own funds are commingled. So your partial risk of loss is continuing. But in case of restricted investment accounts or in restricted Mudarba, in which your funds are not commingled, actually the risk of loss on the variable return part is not there, and your decision making is in a fiduciary capacity. So unrestricted Mudarba becomes off balance sheet. Unrestricted Mudarba, generally speaking, remains on balance sheet. Further details with regard to that can be referred to in the control standard in the table that I have referred to. Coming to Wakala. Wakala is actually done as a principal-agent relationship. So all the functions that you do in a fiduciary capacity. So unless the Wakala funds are commingled with the Mudarba fund, that is paragraph number, I'm forgetting that specific paragraph of FAS 31. Unless that commingling is there, your Wakala, irrespective of the instructions, are restricting you for investment purposes, or those are absolute. But the agency principal relationship does not give you right to variable returns and does not give you the power which is for your own benefit. It gives you power in the fiduciary capacity. So from that perspective, we do not distinguish in case of Wakala to be restricted or unrestricted for the purpose of keeping on balance sheet or off balance sheet. For us, Wakala bil istismar as per FAS 31 is always off balance sheet. Only possibility of having Wakala bil istismar as on balance sheet is when it is commingled with unrestricted Mudarba, which is done through our internal contract in line with the Sharia principles and rules. Internal agreement of terms and conditions, etc. is there. Considering that, the application of those criteria with regard to restriction or not restriction applies only to Mudarba, not to Wakala. And for Wakala, being on balance sheet is not because of restriction or not restriction, it's because of a reinvestment contract in unrestricted Mudarba. I think either I'm too much confusing you guys because I can't see too many questions coming in. So I know there are so many complexities in that. So I would request you to feel free to ask any questions with regard to any clarification that you may need. I know that I have tried to explain it in reasonable detail, but I know there are so many confusing factors in that. So please feel free to ask the questions and to make comments with regard to the text of the standard or any of the treatments, etc. as you like. And again, if you want to provide the comments later, please feel free to send your comments to accounting@aofi.com. Now, coming to recognition, measurement, and derecognition. Now, we are not talking about recognition in the books of the bank. We are talking about recognition in the books of a virtual entity. In paragraphs 8 to 20, recognition, subsequent recognition, and derecognition refers to the act of recording and measuring and removal of assets and related transactions from the virtual reporting entity, distinct and separate from the institution's assets under control. Now, the question is, why we are going in that much detail, asking for this much, putting a standard, and if it is off balance sheet, let it go. Why you are going in that much detail? This is a question that we need to understand, that actually for some of the Islamic financial institutions in some of the markets, management of investment accounts on an off balance sheet basis is a big business. At times you have significant amounts. You have at times significant amounts of investment and underlying assets which are in form of balance sheet investment accounts. So for the purpose of true and fair presentation to the all the relevant stakeholders of Islamic financial institutions, it is very important that an appropriate presentation and disclosure mechanism is there to disclose, to present and disclose of balance sheet investment accounts. So while they are not part of your own balance sheet, but those are part of a very significant aspect of business that you are managing. So that managed business has to be presented and reported as a part of your own financial statements, not as owned, but because you might be generating good returns from them, and because you might have fiduciary responsibility with regard to them. For example, if you fail your fiduciary responsibilities with regard to those assets, the responsibility and liability will come to you. So for example, due to my willful neglect, due to my mismanagement of funds, due to my gross negligence, if there is a loss in those investment accounts, I am required by Sharia, by law, by contractual obligations to make good that loss. So an adequate information with regard to all these off-balance sheet assets which are under my management is an important aspect for accounting, regulatory, and all other information need purposes. We have a question from Brother Muhammad Jawad. What may be the disclosure requirements for off and on balance sheet asset? Brother Jawad, we are just coming to the disclosure requirements with regard to the off balance sheet assets now in this standard, and the on balance sheet are contained in the quasi equity and other investment accounts standard, on which public hearing will be held shortly, inshallah. So, selection and adoption of accounting policies. The accounting policies applied by an institution for the purpose of off-balance sheet asset management shall be consistent with its overall accounting policies developed in line with the relevant AOFI phases, unless use of such accounting policies results in an accounting mismatch or does not reflect the business model of the off-balance sheet assets under management. This is a very important aspect. Sister Farida, can you make a note of my comment that this wording need to be better reflected in the significant changes? In the significant changes, this part is not better reflected. Actually, when I explained, it included this aspect, but about the accounting mismatch issue, etc. But the written part with regard to significant changes does not clarify. So what we are saying that whatever off-balance sheet assets under management you have, in respect of their accounting, the normal policies shall be generally the same as per the normal accounting policies of the institution, which have to be in accordance with the AOFI phases, relevant AOFI phases. But at times it may reflect an accounting mismatch, or it may not reflect correctly the business model of these off-balance sheet asset management. So for example, there is a fund off-balance sheet asset management which are managed primarily for short-term returns on a net asset value basis. I'm just giving you an example. So if it is invested in stock markets or in other commodities, in other assets which are having frequently changing values. So in that situation, having an accounting policy other than fair value may create an accounting mismatch, or they may not reflect the business model of such of balance sheet assets. So while you may have normal accounting policies, including, like, for example, you may have sukuk on held to maturity basis, but the business model of this this off-balance sheet investment account might require that you need to put it on a fair value basis. I'm just giving you one example, but there can be multiple examples of these issues. So the accounting mismatch issue or the business model issue may require you to have a different accounting policy. We are going to discuss the impairment related issue going forward in this discussion, inshallah.
Brother Omar, if you allow me.
Yes,
we have in the chat box, we have a comment in French. If I may just give you the skin about it. It is from Abu Bakrin Diallo. He's asking, he's saying accounting for Islamic operations must have its own accounting principles due to the very nature and spirit of the operations. So specific account must be created in order to highlight the reality of certain balances. So in particular, at the closing date of the accounting period or year, the balance of operations in progress on the Mudaraba, Musharaka, Sukuk, etc. at the closing dates are eligible to appear on the balance sheet. So being such transactions being or involving real businesses, assets under management are far from negligible in terms of transaction volume for the operations and based on the Islamic or Sharia precepts. He's saying here at the end of it, their place is not off balance sheet.
Thank you very much, Brother Abu Bakr. What I suggest that this answer to your question may not be applied in a short discussion like this. Actually, first thing, all AOFI standards are aimed towards providing the information that you are referring to. So we try to provide all those information. Even in the off-balance sheet asset under management, we have asked to provide the relevant information. So about Musharaka, Mudarba that are underlying, you need to provide all the information. However, the challenge that we have is with regard to what remains on balance sheet and what remains off balance sheet. The point is that some of the Islamic financial institutions, particularly in the GCC market and some other markets, have off-balance sheet investment accounts. Those investment accounts, like I can give you an example. One of the investment accounts that I am aware of, balance sheet one, is handling investments in the United States real estate. This is in my knowledge. There is one. There is another. So the bank is not having its own investment in that one. Rather, the bank collected funds, and those funds, the bank acted only as a manager. I'm aware of a bank in Bahrain that did a restricted investment account for leasing an aircraft to an regional airline. So whole aircraft, obviously, which is millions of dollars, actually nearly $100 million, that aircraft was actually invested through one pool of investments. Now, the bank did not invest its own money in that, and rather it just pooled monies and passed it on and took only its own management charge as in form of a mudarba, like mudarib share, without taking the risk of loss. So this is another example where the asset has to be and is to be considered off balance sheet because it's only of a single purpose transaction in which the power as well as the power was only in fiduciary capacity. It was only for one purpose. It was not for any other purpose other than investing in the lease for that specific asset. And obviously the variable returns element was not there, that the bank was not having a loss element on that. Having that aircraft on the balance sheet of the Islamic bank, I believe would not be the true and fair picture of the transaction. So those are the transactions in which actually having an off-balance sheet accounting treatment with appropriate disclosures is a requirement. This is something that we do not want to compromise, that is the presentation and disclosure appropriately for all these assets, but putting them on balance sheet will unnecessarily and arbitrarily inflate the size of the balance sheet without actually having the risk and rewards of those assets. I'll move on now. We can have more discussion points on this going forward. Initial recognition. I'm not going to read all of it. In a nutshell, the initial recognition requirements are similar to another investment account, which is off balance sheet. The only thing is that the initial recognition is not done on your balance sheet. Rather, it is done on the separate statement. So you keep the accounting records, but those accounting records are, instead of being reflected on your balance sheet, they are reflected on the statement of balance sheet assets under management, but the record keeping requirement is there. So the initial recognition is more or less similar to other AOFI standards, similar to more or less what the IFRS says. Then One important point is that initial recognition shall be on the fair value of the consideration received, which is again similar to AOFI and IFRS. On the initial recognition of an acquisition of underlying asset according to accounting policies. So you need to adopt relevant accounting policies in line with your own accounting policies, except for the situation, as I mentioned, with regard to the accounting mismatch or the business model changes. So you will recognize the acquisition of the underlying asset according to those accounting policies. Subsequent measurement will be done according to the respective accounting policies and shall reflect the residual interest in net underlying asset. This is the key, that the way you present the statement of off-balance sheet assets under management, it shall be having the residual interest in the underlying assets. Next is about subsequent measurement of assets and if there are any liabilities, because at times there in a fund there are at times liabilities as well, because some of the funds are at times leveraged. So those liabilities can be temporary qard or temporary financing transaction from the bank itself, or those can be from the market. These are to be done according to, particularly if there are Muraba transaction and others, it may include some of the suppliers advances that you have paid, suppliers credits that you have to pay. So considering these things, these are to be done according to the respective policies as we discussed above. Impairment and credit loss is an important issue. The point is that impairment and credit losses write-off attributable to the underlying asset shall be recognized according to the accounting policies adopted for the purpose of off-balance sheet asset under management in line with the respective OFI phases, respective Sharia principles and rules and contractual terms. Now, the point is FAS 30. FAS 30 does not mandatorily apply on off-balance sheet assets under management, but you can develop accounting policies similar to FAS 30 so you can have expected credit losses and impairment according to the similar policies. The other option is that if you don't book impairment according to FAS 30 and according to Sharia and the contractual terms, you can decide that you will record only the write-offs. So that is a possibility that you can have. So the option of not recording the losses exactly as FAS 30 is available under the OFI framework. This is one of the important areas where we may request the experts to provide their comments, because the rationale for excluding off-balance sheet assets under management from the ambit of FAS 30 was that the bank the bank or the financial institution is not subject to risk on those assets. Any risk of these assets attribute to the owners alone, owners of that investment instruments. For example, I was talking about the lease transaction for a airline. So in that situation, the bank is not taking any risk on that. So bank is not required to apply FAS 30. But the question is, with regard to that investment fund that was created to lease that aircraft to the airline, the question is, does this fund follow an accounting policy similar to FAS 30, or applies the accounting policies on the basis of actual impairment or write-off that is coming? So this is something on which we have kept the option open in the hand of the investment instruments. Considering one single situation that you have only one asset in the investment fund and the airline is actually doing good, then you might not need to do an expected credit loss assessment and everything. All these things might not be required. But this is an area which is, as of now, a bit open. The institution may decide that they do not want to go for any impairment on that part on an ongoing basis similar to FAS 30, because the direct risk of loss is attributable to the investors. So if there is a loss, that will be passed on. Now I can have some questions. First is from Brother Muhammad Jiddatom. Assalamu alaikum and welcome, brother. It's always you contribute very well to the public hearings. Thank you very much for joining in again. In case of participatory investment instrument, it is entitled only to fixed or variable returns, including incentive, share of profit, or a combination thereof according to Sharia principles and rules as remuneration against the management of the underlying asset. However, the institution is not entitled to any residual interest in the underlying asset except to the extent of such established remuneration. Can you highlight more as well, specifying an asset pool separately from the common assets of the institution without commingling with the institution's fund or unrestricted Mudarba investment account? So So first part is actually your comment, no disagreement on the comment. The institution is not entitled to the residual interest in the underlying assets. So in a nutshell, brother Muhammad, what I would say that first thing about the instruments part. First thing about the instruments part, what you have written, no disagreement to that part. That is similar to what we have written in the standard already. Maybe I'm not very clear whether you want more clarification on this part, or so I'm not very clear. So if you can put a question on that separately. But your second part of the question, can you highlight more as well, specifying an asset pool separately from the common assets of the institution without commingling the institution's own funds or unrestricted Mudarba investments? So I gave you an example of some of the restricted investment accounts that we know. I can tell you in the GCC market and some other markets, you will find these sort of investment accounts commonly. However, there are some more regulated markets, like for example, in Pakistan, Malaysia, etc. The banks may not generally be having investment funds. Rather, they need to have investment funds through asset management business, which in some countries is subject to a subsidiary, that is asset management subsidiary, that handles those funds. And in some countries, it is the bank that can directly manage those funds. But here I can answer the question from our other brother, Fathur Rahman Saleh. In this standard has some relation to FAS 14 on mutual funds. I clarified this thing in the scope, brother. So the point is, in those countries where the regulatory requirements and the legal requirements do not allow the banks to have their own restricted investment accounts unless they create mutual funds. So in those situations, the mutual fund becomes a legal entity, either as a corporate entity or as a trust, and it is subject to separate full governance requirements like Islamic financial institution. It becomes a small financial institution. It is subject to all financial reporting requirements on a quarterly, half-yearly, and annual basis, and subject to audit, Sharia board. All these requirements are there. So whatever is a formal mutual fund, which is a separate legal entity, that is subject to the requirements of FAS 14 of AOFI. And this standard actually excludes whatever is in form of a legal entity. So the relation to FAS 14 is not there. Rather, it is an exclusion that if a fund is subject to FAS 14, then that is not subject to this one. Now, coming to further explanation of Brother Muhammad's question. So we are aware that there are some investment banks, there are some commercial banks that actually create restricted investment accounts. Two of the examples that I mentioned were with regard to the real estate investments in the US and investment in an aircraft for an airline. These are just two examples, but you will find certain more examples, particularly for high net worth individuals, where you are talking about 10, 20, 50, 70, 100, $200 million of investments. In those situations, this is a very common practice for some of the large Islamic financial institutions and for the investment banks who are working on Sharia compliant basis, that they create these restricted investment funds. So at times they have multiple investors, and at that time they do it only for one single investor as well, which is similar to the wealth management activity which is done by the conventional institutions. Even for the conventional institutions, the wealth management activity is normally kept off balance sheet. Only a little bit of disclosure is there. Rather, we are ahead of them because we are asking more disclosures with regard to these transactions. In a nutshell, the other issue about commingling, the point is that if you commingle your own funds, either you commingle Mukala with an unrestricted Mudarba, or you commingle your own funds with the Mudarba accounts. What happens that your decision making with regard to the investment instrument becomes a bit more strong because you are partially the owner. Secondly, the variable return condition is completed, because if I am Mudarib and you are Rabbul Mal and I'm dealing only with your funds, it means that I'm not subject to a risk of loss, except for negligence. Negligence doesn't count for this purpose. So from that perspective, if I am using your funds for the benefit for the investment purposes without involving my own funds, my variable return condition is not complete because I'm not subject to loss. In that situation, my control is not complete and it becomes off balance sheet. This is something that is again subject to certain interpretations and more of the subject of the control standard, as I mentioned, and I refer again and again that the table provided in the control standard. Sister Farida, if I suggest, if you can kindly provide in the chat window for the benefit of all participants, the link to the control standard along with the paragraph number. I think it's table A of the control standard where we have provided these details. So it will be beneficial for all of you. Brother Muhammad has further clarified, it's more clarification I need to clause according to Sharia principles and rules due to underlying assets. Brother Muhammad, actually the point is that the condition that we are talking about, like the one that I gave as an example. So the point is, according to Sharia principles and rules, in case of Mudarba, you are not subject to loss. The same example that I mentioned. So if I create a fund on Mudarba basis, for which I'm not commingling my own funds, so my risk of loss, and this is not an ongoing basis where investors are coming in and going out and my investment amount is increasing and decreasing. Rather, it is only about the investors' fund which are invested in one or multiple assets according to their restrictions for that. So in that situation, my risk with those assets on the loss side is not there. So these become off balance sheet for me. That is what we are trying to clarify.
Brother Amar, there is two raised hands here. We have Akram Ghattam.
Okay, just give me a second. There is another comment in writing. Let me take that one and then we'll go for that. Thank you very much, sister.
Okay.
Impairment on the underlying asset means that we have to apply a standard like IAS 36 and to check on impairment test for the investment part of the pool. Did you confirm? Brother Mahdi, yes, I like IAS 36, but in AOFI framework, it is FAS 30. FAS 30 covers both aspects. Like IFRS 9, impairment and expected credit losses like IFRS 9 and impairment like IAS 36, both are covered in our FAS 30. So yes, your answer is correct. But we are not saying it mandatory. We are saying that it is an optional thing as of now. As per AOFI, this is optional to have an impairment policy here. But then there is a condition about onerous commitment on which I'll take you in the next paragraph. Okay, so if we can allow Brother Akram Ghattam to just make comments. Please, please, my apologies if I did not pronounce your name properly. Yes. Brother Akram Ghattam.
He's allowed, he can talk. Also, Mahdi bin Akram, he is his hand. Mr. Akram?
Mr. Brother Mahdi bin Karam, please, if you can raise, if you want
Hello?
to raise. Yeah, I respond. Walaikum assalam. Welcome, brother. I responded to your comment in writing, but you want to add anything?
I would like to thank you before for your presentation. Then I have to just to make a comment on the impairment on first impairment. Do we have, I don't know, like FAS 28? We have impairment for underlying assets for inventories, for example. We have to apply IAS 36, like IAS 36. Here we have to apply maybe a similar
FAS 30. We have to apply FAS 30.
FAS 30, yes. FAS 30 is on financial assets. It's not on underlying assets.
No. FAS 30 is on both. We believe that all Islamic finance assets are not financial assets. Yes. So if exactly, it is a financial asset is receivable, so receivables are subject to expected. So the name of FAS 30 is impairment, expected credit losses, and onerous commitments. So if you see that that all the three are covered in the same standard, so it is similar to IFRS 9, similar to IAS 36, and for some parts similar to IAS 37. So the onerous commitment similar to IAS 37, impairment similar to IAS 36, and expected credit losses similar to IFRS 9. So we cover all of them in one standard.
In one standard, it's infrastructure. Yes, I agree with that. Yeah. The other point is that about the cash that we received from the investor when we have to invest in a pool, like here in restricted investment accounts. So how it was, off balance sheet from a part and cash in the balance sheet from the other part. How we can
this will not be on your cash, rather it will be appearing as cash in. So you need to do your chart of accounts properly, because this cash will not go to your balance sheet. So it will never go actually to your balance sheet. Rather, day one when the cash comes, it will go to a separate separate account. So but if you don't maintain separate account, in that situation you create a cash in your account and a liability to the fund in your accounts, and the fund will show a receivable from the bank. So preferred option is that in the chart of account, this cash goes directly to a separate cash account, which is not going to your balance sheet, rather going to the statement of assets under management, of balance sheet assets under management. However, if this is not possible for any reason, you do not have a separate bank account, then in that situation, you will, in the bank books, you will show cash 100, payable to the off-balance sheet fund 100, and the off-balance sheet fund will show receivable from the bank 100. So when the asset is purchased, bank will pay, and this receivable and payable will be set off. Am I clear?
Yes, the separate cash account, where we can find this separate cash account.
Okay, the preference is that always it should be in separate bank accounts, that separate accounts that you create. But if it is not happening, so in that situation, you just create the accounting treatment as I mentioned.
Okay. Thank you very much, Mr. Omar.
Thank you, brother. Thank you very much for raising very good questions and very good comments. Thank you very much. It's always helpful to help people like you providing comments like this. Thank you again, brother.
Thank you.
Okay, so we move ahead now. Brother Akram did not raise any comments, so we'll see later, but let's move ahead now. So now coming to the next point about reserves. So we believe that restricted investment accounts are virtual entities, but for providing a smooth return, they also can create risk reserves in line with FAS 35. Further details with regard to risk reserves are there in the FAS 35, so we do not want to touch the subject here. We just mentioned that a virtual entity of like this off-balance sheet virtual entity can have a FAS application of FAS 35 to have risk reserves to manage the various risks. Where a profit, it can include profit equalization reserve as well as investment risk reserve. Where a reserve is maintained for the off-balance sheet asset under management, the impairment and expected credit losses, but write-offs and fair value losses pertaining to underlying assets may be set off against such reserves. Now, coming to another issue, provision for loss due to misconduct or negligence to be recognized by the institution. Loss due to misconduct or negligence on the part of the institution as established in line with Sharia principles and rules shall be borne by the institution and hence shall not be recorded as a loss for the virtual reporting entity. So for example, the virtual reporting entity got a loss of $100,000 because of a negligence or misconduct or because of non-compliance with the contractual terms. Sister Farida? I think in other standards, we have said misconduct, negligence, or non-compliance of the contractual terms also. So I think here we also need to make it consistent. So if I did not...
If you may allow me, at times we say breach to contract, breach of or breach to contract.
Just see the wording that is approved by Sharia committee in case of other standards. So we make it consistent, okay? Thank you very much, Brother Majd. So a breach of contractual terms or misconduct or negligence, whatever the terms are finalized by Sharia committee, we need to write it this. So in that situation, the virtual entity will consider a receivable. So they will record a receivable from the institution, and the institution will record a payable to the virtual entity, that is the fund. Now, coming to reassessment of the institution about these things. So in rare circumstances, the institution may need to inject its own funds in the participatory investment instrument, especially in the case of bridge financing or when the put option is exercised partially by the investor before the maturity of the underlying asset. In such cases, the institution shall make a reassessment whether the funds are in the nature of receivable by the institution and payable by the virtual entity and are not eligible for accrual of any returns, and proportionate ownership is acceptable and ascertained. The investment in the institution is in the nature of at par with the other equity investors of the virtual entity, or multi-level investment arrangement exhibiting the characteristics described in relevant UFI phases are to be presented accordingly. So considering these options, you need to reassess as to whether you actually still do not control it or you now control it. So this is something that need to be done on a time-to-time basis. Institutions, okay, now because next is the next topics. Before that, let me take a question that I can see. So there is for money to carry on project outside Islamic country. It's a completely irrelevant question, to be honest. I don't have an answer to this. Some of the countries which are not Muslim majority have Islamic financial institutions available. Similarly, at times the institutions that are in the GCC and other Muslim countries, they actually invest in some of the projects which are outside of their own country and in some other non-Muslim country as well, like United States. I mentioned there were some investments by some of the funds in the GCC. So these are the things on which I would say that this is a business related question. My answer is yes, it is possible according to the relationship and reliance on the investment and the investment opportunities, strength with regard to the returns, everything. But this is not relevant on this subject, so I will not go in more detail about this topic. Thank you very much. Now, coming to a very challenging question. The question is, for example, if the institution has a policy of not having application of FAS 30 or other impairment accounting policies for the fund. So the fund is not having any impairment as of now in the books of account. But there is the underlying asset of for example, the underlying assets have a maturity of 5 years. And the investment accounts and this off-balance sheet investment accounts, they have a maturity of 3 years. So there is all probability that after 3 years, the institution will pay the investors and will take the asset to itself. If the underlying assets have a maturity which is more than the contractual term of the participatory investment instrument. In that situation, there is all probability that the asset will come back to the institution. So this is the first condition. And the second condition is if the underlying asset is expected to have a value lower than the current carrying value at the time of underlying asset reverts to the institution. So that asset which is not impaired as of now in the books, but has a probability of impairment going forward. So when you actually get it into your books after 3 years, it is subject to a loss. This is a unique situation, but if you don't book impairment in the funds, then it is quite possible that this situation may arise very frequently. So considering that situation, we believe that it's a very important element to record a probable loss to the institution on reversion of those assets or acquisition of those assets by the institution at the time of maturity of investment accounts, unless it is evident that the losses at that point will be passed on to the investors. Now, this is a situation which creates an onerous commitment, because considering the situation, this is all probable that the institution will be taking back the assets or will be acquiring the assets. And this is all probable that the investment accounts will not be getting a loss on that, but the carrying value might be less. So in that situation, their fair value will be less than the carrying value. So a loss in that situation, if it is probable that institution is going to take a loss after 3 years, then you need to start having a provision for onerous commitment at that point of time. This is in accordance with the requirement of FAS 30, and this is actually addressing one of the challenges, because some of the industry participants and auditors challenged that FAS 30 is not applicable on off-balance sheet investment accounts. So it may create a mismatch, and it may create challenges with regard to Islamic financial institutions. So the solution that is like contained in this paragraph 18 and 19 is actually a summary of some of the earlier technical clarifications that AOFI has provided to the market participants. Derecognition: the investors managed fund of off-balance sheet assets under management and the underlying assets are derecognized from the virtual reporting entity when they satisfy the following criteria. A, the control of asset is transferred to another party through sale or otherwise, for example, through gift or settlement, or there are no future economic benefits expected from use or disposal of such assets. For example, if the asset is expired or surrendered, or the asset is destroyed or fully impaired, or the underlying contract is terminated and there are no further legally enforceable obligations in the virtual entity. Sister Farida, please make two notings. Number one, some places we said virtual reporting entity and some places we said virtual entity. So I think we need to be consistent. That is number one. Number two, as suggested yesterday by the PIMCC, the virtual entity related discussion that we have referred to into Windows standard, it should actually be included in the basis of conclusion of this standard also. We don't only refer to other standard, rather we need to explain it in the basis of conclusion of this standard. And if necessary, as recommended by the PIMCC, we might need to put a definition of virtual entity or virtual reporting entity, depending on whatever term we finalize in this one as well. Presentation and disclosure. So we have put in some presentation and disclosure requirements in this standard going forward. So they are like, you have a statement. The statement is there. Some of the basic requirements of the statement are contained in FAS 1 in paragraph 136 to 139. But in addition to that, we have issued the technical release on illustrative financial statements, which include a illustrative presentation of balance sheet assets under management. This standard actually endorsed the requirements which are there in FAS 1, and for that actually the statement we mainly say the statement of off-balance sheet assets under management shall provide adequate disclosure. One thing to clarify, the statement of off-balance sheet assets under management is a movement statement. So we are not asking a separate balance sheet and income statement for off-balance sheet assets under management. Rather, we are saying that you can provide a columnar movement statement, but necessary disclosures need to be provided in the notes to the financial statements. So it should have the balances for each of the significant asset under management. You need to have balances at the beginning of the period, investors additional capital received during the period, withdrawals, disinvestments, maturities, then net profits and losses, including revenues, expenses, fair value gains and losses, impairments and losses, credit losses, write-offs, net of reversal, if any, and investments agency fee, Mudarib share, etc. Sister Farida, here the losses might not necessarily be in the brackets. Okay, in this paragraph D. Losses are not necessarily to be in brackets here. Transfers to and from the risk, again here transfer to and from, not necessarily in the bracket. In the illustratives, we have provided them in bracket to identify what is negative and what is positive, but in the standard, it is not necessary. Distributions of profit during the period and balances at the end of the period. Disclosure of changes in balance sheet balance sheet assets under management for significant virtual reporting entities. So institution shall disclose appropriately in form of individual statements or detailed disclosure as part of notes to the financial statement, the information required in paragraph above for each material virtual entity. So either you provide in the columns or you provide it in the notes to the financial statement. It's up to you, but for each significant reporting entity, you need to do it. The main point is that if a virtual entity is more than 10% of the equity of our balance sheet asset management or in excess of 5% of the total equity of the institution, then it will be considered a material or significant for this purpose. Then there are disclosures with regard to the changes, in the line with the requirement of FAS's nature of underlying assets. And additional disclosures are there about provision for owners' commitments, any recourse available for the investors against the potential loss, details of ring fencing, if there is any, details of hiba, gift, etc. by the institution, etc. So these are the disclosure requirements. The standard will have the effective date of January 2025. This is suggested, and we request your comments on that. With regard to the standard, I would just say that it's an improvement standard. So maybe a long waiting time for implement effective date might not be necessary, but still it would be good if you can provide your comments on that. With that, I would close the presentation and we'll take any additional comments that we may have before we close today's session, inshallah. So I cannot see any other comment in the question Q&A tab. Is there any hand raised, Sister Noor, Sister Farida? Okay.
No.
So with that, brother Maj, I hand it over back to you for closing remarks. And if Sister Amal, before the closure, if Sister Amal as chairperson of the working group wants to make any comments, first to her, and then you can close the session.
Sister Amal?
Yes.
Please.
Yes, Brother Majd. Yes, as Brother Omar mentioned, the concept of control intersects widely with this standard. So I recommend all the participants to read the two exposure draft with together. Yes.
Okay, thank you, sister. Thank you very much. It's been our pleasure to have you today as being a UFI accounting board member and chairman of the working group, the respective working group. Thank you very much. We would like at the end of, in conclusion, at the end of this very important public hearing, part of the series, a series of important public hearings for this standard as part of standard or the revision project for standard 27. We would like to express our deepest and sincere thanks to all the participants. Thank you very much, and we look forward to having you again and again, inshallah, in the near future. We still have a number of public hearings that will be held this month and next month, inshallah, both in English and Arabic. We look forward to seeing you again. Thank you very much, and all the best. Assalamu alaikum wa rahmatullahi wa barakatuh. Assalamu alaikum.